Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Hope everybody's doing well. Hope you're ready for Christmas or pretty close to it. All right. Just to dive right in here, one of the things I get questions about a lot is isn't Black Rock buying a bunch of stuff? Well, first of all, it's Blackstone. Okay, and even there was a recent thing with Elon Musk saying he actually agrees that yeah, it's kind of a myth that Wall Street's buying up all the houses. It basically, and there's an article in Housing Wire we came out with about a year ago, but it was it was really about a maybe 1 to 3% Wall Street, Blackstone type of buying was going on out of the entire market. So um, I guess you could say, a decent portion, but not like kind of the myth and hype that a lot of people out there were talking about. But anyway, just wanted to kind of bring that up right out of the gate. Speaking nationally, we've got some housing market dynamics going on. Let me share my screen here with you and jump right in. Okay. So, you know what? Before I get into this, let's talk about this. We had our inflation information come out this week, which does affect the kind of bond market, and the Fed reacts to certain things depending on which data points of inflation that we're talking about. And that the Fed tracks PCE. Some of this feeds into that, some of it doesn't. But overall, kind of keep an eye on all of it because inflation it definitely is going to be a marker for rates. As far as what the bond market is looking at and reacting to. Also, obviously, like we've been talking about, because the Fed has kind of tracked this, and what they're going by is unemployment rate, jobless claims, all that. That's what they're really tracking at a higher, even a higher level than inflation when it comes to their policy on more mortgage or federal funds rate reduction, which indirectly can have an effect. On the mortgage rates, but the bond market has been ahead of these guys, as we've been telling you right along. So anyway, that was the big news, I guess, in the past week, um, or some of the biggest news. Wholesale prices rose zero point 0.4 in November, more than expected. So year over year, we're down basically, but month over month, it was up a little bit more than expected in the, I guess, overall inflation rates, and they're different data points of inflation that they check. There's PCE is what the feds actually are tracking, and it even talks about the labor report here. And some people have been, some people will refute this with different models and charts, but some people are actually saying that, and it wouldn't surprise me at all, but January, February, we're probably going to see, according to them, a downward revision in the number of actual jobs. And keep in mind, these jobs that we're talking about out there, again, it's important because the Fed tracks it, Fed's fund rate, how they react to the Fed's fund rate reduction, how that indirectly correlates, or may affect the bond market and mortgage rates and all that, because we're tracking the 10-year Treasury. So all those factors are important, and some people are saying there may be a downward revision of 800,000 jobs coming in January that'll show up, um, or by February at the latest. So we'll keep an eye on that. That would be something that might be a further softening or breaking of the job sector, because even though the numbers are still, ending their seasonally adjusted at 242 for the week of December, considerably higher than the 220 forecasted, up 17,000 from the prior period, like it says here. um, you have to kind of keep in mind with those unemployment claims. A lot of times we have these revisions. What we're tracking is what the Fed is tracking, and that is, if they were to get up to, let's say, 4.3, 4.4 on unemployment rate, that's going to be something that's going to break the labor market. Right now, we they keep saying there's a softening, because a lot of these jobs are government jobs or part-time jobs or seasonal jobs. They're not really, you know, robust middle class, upper middle class jobs to support families on. Okay. Or, the government job sector, that's that can be an inflationary factor right there. Plus, in our kind of a, um, you know, constitutional republic, you don't really necessarily want to see tons of government jobs growing faster than the private sector or manufacturing and all these other things. So anyway, without getting too far into the weeds of that, that's kind of the thing. And of course, a lot of this higher inflation was already baked in. Prices, on homes and everything else went sky high, and trying to get that down is like a big thing. Some people are saying because the Fed's target since Alan Greenspan has been this 2% number in um, their inflation rate target or rate of inflation. Um, and 3%, some people are saying 3% is the new normal. We'll see. But that's still their target. That's still what they're trying to get to. The Fed, wants to try and get to that target, which it talks about here. The Fed, it says here that the Fed tracks the PCE, like I mentioned earlier. However, the CPI and the PPI feed into that measure, of course. But this uh, basically sets up the Fed for next week, year over year. Good chance that they're still going to do 25 basis point reduction, which really isn't going to do anything because we have this Fed policy that's way behind the mark. Hang on a second. And sorry about that. And that the Fed is way behind the bond market, and the bond market is really what's setting the mortgage rates up. The Fed's fund rate is different than mortgage rates. So what we track is the bond market, meaning the 10-year treasury. And the last 5 days, we can see that this number has gone up, right? It's gone up the last 5 days. Here it was today. Again, this number here, wherever it is, should be historically about 2 point difference with mortgage rates. Okay. It's kind of a slow dance, as they call it, to mortgage rates. And that means that in this case, at 4.39, we should be at 6.39 or less because it's usually about 175 to 200 point difference. So in that case, right now, our mortgage rates should be right in line with that. But where are they? They are actually up a little bit at 6.9. So we call that the spreads between the 10-year treasury and mortgage rates. That 10-year treasury and mortgage rate split really has to, it really has gotten better. It really needs to get better. And by doing that, with having a better economy, which I think is right around the corner for us starting next year, we're going to see those numbers come back into line. And that's going to, in and of itself, bring us lower mortgage rates. Okay. So hopefully that makes sense. And, getting into, as far as the supply of homes and inflation, that's obviously across the country something that is a big concern because those the supply of homes, whether you agree with it or not, the numbers show that they are way down. Okay, so we have a shortage of homes for the number of people that are interested in buying. So we really have to get a grip on that. We've talked about how that may come about over the last few weeks, and then hopefully that takes off. But the other numbers here that I wanted to take a look at is 82 days closed on market is where we are right now in the Phoenix area. Now, we've been talking about all the issues with the Cromford Report has been reporting that there may be some issues on the horizon. And I really think that we're actually back to normal all of a sudden, or kind of heading back in that direction. And what I mean is, we just saw in the last week or two a little bit of a drop off and again, during this time of year, you got to kind of take things a little bit with a grain of salt. But just like right now, overall, all property types, all property listings that are active are 21,000. That's down a little bit, just anecdotally. If we look at the numbers of active listings, they're down a little bit because they were getting worried that there was all this inventory building up at the end of the year, and usually it goes down. Well, it's a little late this year, and it has gone down. The pending has actually gone up a little bit, so that's a good indicator right there into the positive. And the closed units are up a hair, so that's a little bit of a positive there. In order to help with the absorption rate and not having a bunch of properties just stacked up at the end of the year and the rate of those being, going up kind of is not the usual norm, but now we're kind of there to the usual norm. 4.5 months supply of homes right now. That means if nothing else came on the market, it would take 4.5 months um, to sell those. And the absorption rate again is pretty good. Uh, this time of year can't expect too much on that. The average list price is 758,000. The average sales price is 689,000 right now, which actually has done a big jump. But I just want to kind of put that into context because usually that's been hovering right around anywhere from in the 560s to the 570s, maybe 580s. And you gotta also take into consideration what is actually on the market as a whole. Okay, and right now below 600,000, there's 66, a little over 66%. Um, this number here of the 600 to a million is a little over 20%, and the 1 million plus is over 13%. So those two numbers have gone up a little bit, actually, believe it or not, this time of year. And this kind of shows you the average days on market with all of these price point brackets. So that's what brings us to the 82 days closed on market, which, and the market climate that we've been in with the higher rates, high prices, massive inflationary rates and things like that over the last couple of years. This time of year, 82 days closed on market is higher than we're used to in the past or normally, but it isn't a giant surprise with the way things have been going the last year or two. So for this time of year. So, but this number did take a jump because of those indicating data points right there. So no, doesn't mean, if we went from 570 last week or whatever to 689 that your property values went up, doesn't mean that it went up that much over $100,000 or anything like that. So within context, it's kind of like when people, you hear people on the you know, these ridiculous people on YouTube or podcasts that know nothing about housing or data points or models or anything. And they're like, oh, foreclosures are up 300%. That was the big thing, like after the COVID forbearance. It's like, yeah, it went up 300% because there were no foreclosures because they weren't allowing foreclosures basically to happen because they shut down the economy and people were like, I'm hurting here. So they had the forbearance thing for a while and you saw 300% jump, but it really, in the context of history, was like nothing. So you got to be careful when people talk percentages and we call them the crash brother bros. The sky is falling, the economy's dying completely, and the housing market is crashing because we had one crash in all of human housing history. And so there's a crash around every corner. So anyway, let me just put it this way: it is mathematically impossible currently with the number of new homes coming on the market, new builds. It is mathematically impossible to have a housing crash because the inventory is way too low, even with the lower demand that we've seen over the last 2 years. In The number of sales are recessionary lows around 4 million or so, give or take a little bit, depending on the last 2 years, going on 3 years that you looked at. But in the context of the number of sales doesn't mean that the prices have gone up. We're going to talk about that in just a second. But and they continue to go up because of low inventory compared to the still high enough demand to keep the wheel turning, so to speak. And the builders are not going to overbuild. They're not going to do what they did during the crash, basically. You don't have the junk loans that you had during the crash, and people just have like so much more equity than they've ever had. So you have a different credit model for people even getting approved. Okay. You have all these forbearance things, or can't foreclose programs. They'll work with you, all this stuff. So on the credit side, you have that. On the inventory side, you have basically a third or less of the homes that you had during the crash. So as far as supply goes, way less. Okay. You've got give or take around a million, okay, versus almost 4 million during the crash. It doesn't equate, guys. The numbers don't math. Okay. So the math ain't mathin'. So anyway, it's mathematically impossible. And then you have this idea that people basically have tons of equity. They have what was the last number, 290,000 or 300,000, something like that. I can't think of it off the top of my head. In equity in a home, for over 40% or 40% of people own their homes outright. You're not going to have a crash with those sorts of things. It's doesn't work. Now, if for somehow magically we had 4 million homes across the country or more for sale, maybe we could have that discussion, but we're nowhere near that. We're nowhere near that. And in the valley, right now, this number here that I just showed you, this 21,000, during that crash, we had like 58, was it about 56 or 58,000 homes for sale at the point of the crash. So anyway, list the sales price ratio, guys. What it lists for, what it actually sells for. What's the ratio there? 97. Usually we like to see that not at 97, but a little over 98. So that's a little bit lower than usual. But again, time of year, the way the housing market's been going this year, people have been getting concessions and all that. We've been kind of a buyer's market to balance the buyer's market this year. So there's the story there for the most part, guys. Again, going into the foreclosures, short sales, lender-owned REOs, HUDs, all that kind of stuff. We just don't really see any, giant numbers there. 97 short sales out of, all those homes for sale, lender-owned REOs. That's like nothing numbers. Negative 40% in short sales closed over here. I've actually closed under contract 3%, a little over 3% on short sales, lender-owned REOs. Zero change in their numbers. So yeah, those are those metrics, guys. Anyway, for the Phoenix area, we're kind of back to or heading back to balance. And so we've seen a little bit of a switch there. The supply is down. Okay. Supply is down. Demand kind of just hovering there. But if that demand comes back at all, which we know after January happens every year, and now that we're past the election and we'll be past the holidays, we're going to see that. We're definitely going to see that go up. So this absorption rate will go up. We'll see more demand come back. We've already seen over 12.5%. Over the past couple of weeks, we saw about 12.5% in application data for new home loans. We saw in the past week, what was it? It grew 6%. I think I have it here somewhere. Yeah, it grew 6% and just in the past week. As far as mortgage application data, according to Fannie Mae, and the sentiment showed a 4% increase just in consumer sentiment. Um, and a lot of people still think it's a bad time to buy. here's the thing. A lot of people think prices are going to come down. They are not going to come down. That's not going to change. Rates will continue to trend down unless something really drastic happens. Um, and we talked about all the underpinnings of the new economy that'll bring that about. So it's really I think a great time to buy now versus later because prices are going to continue to go up. This year they went up. Um, let's see, what was it? 6.6% in the greater Phoenix area. Here's the contract ratio map, guys. Oh, yeah, by the way, Chandler, Fountain Hills, Scottsdale, and Phoenix proper, uh, Avondale, those are all in um, buyer range, or I'm sorry, in seller market range, barely. Remember, over 110 on the index is a seller's market. Those are over that 110 mark. Paradise Valley, Glendale, Cave Creek, Gilbert, Mesa, and barely squeaking in there, Peoria are in balance range between 90 and 110. And then everything else, Surprise, Goodyear, Queen Creek, Maricopa City, and Buckeye are all in buyers markets. So this is a contract ratio map. Right now, our contract ratio as of this week with the latest numbers that we can pull up. Why didn't that switch over? Is overall for the greater Phoenix area contract ratio, the number of under contract versus active as of the 9th is a contract ratio of 30.4. So that basically puts us right there. Let's see, where's my number? Yeah, 30 is balance to warm. So we're barely at that balance according to that. And this is a earlier indicator than this chart. Okay. Why? Because it shows us what's under contract. Not that all, sometimes properties fall out of contract, but whatever does go under contract. Okay. So there's application data like buyers coming in, getting approved for a home loan. That's a good indicator for about the next 30, 60, 90 days that we're probably going to see if that number goes up, we're probably going to see more activity. With this, it shows us properties that have gone under contract, okay, uh, has gone up a little bit, not much, but it shows us that we're barely into the balance to warm. So we're kind of heading back into that. So the Cromford is saying, okay, we were getting a little worried there for a minute with all that extra inventory, but that's now not a thing. So we're seeing, some more properties go under contract, like I mentioned on the other chart. So we're kind of heading back into balance. Again, nothing crazy, no fast, huge swings or anything, but it's a good indicator for this is a good indicator for about the next 30 to 45 days, because that's about a usual escrow period with a loan. Um, and then from there you kind of go from there. But these are the kind of the areas right now. Chandler, uh, we have what is this here? Why is this not popping up for me? Glendale. That's bothering me. What was that? Uh, okay. Anyway, Chandler, um, maybe part of Gilbert, Chandler area, Tempe right there. That's kind of showing a hot area. And then you got Glendale giving that hot portion there and a hot contract ratio. So those are kind of the only areas right now really that have that hot mark. As far as this indicator here over here on the left, 60 to 80, it gives us that hot market indicator. So anyways, guys, the median sales price, by the way, year over year, we're at about 450 on the median sales price as of December 6th. Last year, right at the same time, we were, let's see, for about 439. Okay. So that's definitely gone up. So, uh, you know, all this basically tells us that, we've got these things happening, good things are on the horizon. We're kind of heading back to a normal balanced market. I would argue that I know it's been tough out there for a lot of people, but really, we kind of get into a normal balanced market for the most part for the most of 2024. I think we're going to head back to balance, heading towards a little bit of a seller advantage by the time we hit to spring. That's just my thing. Redfin, just without getting too far into the weeds on this, Redfin citing uh, a renter's market. As home prices continue to rise, they're saying rates are still going to be high. So they foresee a rental affordability thing and improving due to more inventory and stable rental prices. Now, some of that inventory that's coming on is also some of those projects that were started during that COVID period or towards the tail end of the COVID period, because a lot of that stuff was taking a couple of years to get done, and they have to fill them. So once we get to the end of that, that means that we're going to see construction people maybe coming out of work, and that's one of the first indicators that we'll see a very large softening. I think very soon. Again, we're not rooting for this. It's just what the Fed is looking at, what the bond market's going to see and react to, and that 10-year Treasury then will react to it. But when those people are out of work and those projects are done, it's not like they're just automatically going to shift over to, um, you know, uh, working for D.R. Horton or something, not necessarily how that's going to go, because again, the builders are not the March of Dimes, and they will only build faster if demand goes up, which means rates have to come down. And all we really need is for rates to get to about six, um, right in that six, right around 6 to 5.7, and we will see, because we've already seen it a few times. It goes there, and then for like a couple of weeks, and then it's back up again. Because of our crazy economy and some of the crazy policies that we had in spending in our government, and that extra spending creates that inflation. Too many dollars printed chasing too few goods gives us inflation, and it feeds into these factors. And then the Fed comes in and is like, okay, we're going to destroy that factor of inflation by destroying employment, by destroying manufacturing or whatever business it is, from hiring people, from putting money into new projects and production. So, um, because it just costs too much to do it. Okay. Um, the cost of money. So, that is what Redfin's saying for rental market. I could certainly see that, although I don't think that's going to last too long, because again, a lot of those projects, um, you know, are going to, they're going to be done, or will be done very soon. So over the next year, I could certainly see that, and a little bit of a softening in the rental market for sure. And maybe because rates are still a little bit elevated, prices are still going up. People are like, I may need to rent for a year, I guess, to kind of get caught up until their salaries get caught up, or they're able to save that money or whatever. There are DPA programs, down payment assistance programs. There are ways to get, into these builders. Some of that stuff is there right now. It's not going to be there forever. Right now is really the best time of year, always, to buy a home. There's usually more deals out there from builders. You can get better deals a lot of times, even from resale homes. But anyways, for all the ins and the outs, please reach out to us. We can help, whether you're looking to sell or buy. We can certainly help you, get you more information about your specific neighborhood and area and community and zip code and all that, so that you can make a better decision on what it is you want to do next. So until next time, guys, thank you, and we'll see you soon.